Hello investor and future investors. We are here to make investing simple and approachable. One easy topic per episode. Short, easy to understand concepts. Step-by-step guidance. No need to rush. We'll take it one step at a time. You don't need any prior knowledge to join us. All you need is the desire to learn and grow. Investing isn't just for experts, it's for anybody who wants to take control of their future. So, if you are ready to explore the world of investing, join us on this journey. Let's learn, invest, and grow together. Welcome to the ABC Invest Journey. Designed for beginners who want to learn about investing in a simple way. A journey where anyone, anywhere, can learn to invest in the stock market. The first episode of the Anybody Can Invest journey. Today, we are starting at the very beginning, understanding what the stock market actually is. Section 1 Basic Definition. The stock market is like a giant marketplace, but instead of buying and selling fruits or clothes, people buy and sell shares, which are small pieces of a company. If you are unsure of what a stock really is, here we will explain. Stocks are shares of ownership in a company. When you buy stock, you are essentially buying a small piece of that company. As an investor, you can typically buy and sell stocks from a company at any time. Now you are named as stockholder. As a stockholder, you have a claim on a portion of the company's assets and earnings. The term stock likely originated from the practice of merchants in medieval times who would display their wares on a wooden shelf, or stock, in front of their places of business. Over time, this term expanded to represent a portion of ownership in a business. When you hear people saying, "I am buying stocks," it generally means they're investing in a company by buying a portion of that company. What are the types of stocks? There are 4 main types of stocks. 1. Common stock. This is the most typical type of stock that represents ownership in a company and provides voting rights in shareholder meetings. 2. Preferred stock. Preferred stockholders typically have a higher claim on assets and earnings than common stockholders, but they usually don't have voting rights. 3. Growth stocks. These are stocks of companies that are expected to grow at a rate higher than the average market growth. They typically reinvest most of their profits into expansion rather than paying dividends. 4. Value stocks. These are stocks of companies that are considered undervalued compared to their intrinsic worth. Investors buy them in the hope that their price will eventually increase. You may also hear stock referred to as Class A, B, or C, which indicates voting rights or ownership control. Blue chip, which refers to stock in well-known, relatively stable companies. Large cap, mid cap, small cap, and micro cap, which indicates company size. Growth, income, or value, which points to companies poised for future returns, dividends, or stock price increases, respectively. What is the first stock called? Stocks go by various names, shares or equities, and their history traces back, and the first stock ever issued is believed to be by the Dutch East India Company in 1602. Back then, it allowed investors to buy shares of the company, and in return, they received a portion of the company's profits. Quick recap. A stock represents ownership that a company sells to the public. If you own stock, it means you have some ownership in that company. But how much ownership do you have? That's determined by the number of shares you buy. Now, what is the stock market? Stock market is the term used in reference to all stock exchanges where investors come together to buy and sell shares of companies from each other. In the past, The stock market only operated physically at stock exchanges, where people met in person to buy and sell. Today, these stock exchanges largely operate online as a digital space that allows buyers and sellers to get the same job done. Globally, there are over 60 major stock exchanges. These major stock exchanges are regulated by either financial regulators or another authority in the country where they are based. This management of stock exchanges helps offer peace of mind to investors that their transactions will be processed in a legitimate and efficient way. What is a stock exchange? A stock exchange is a marketplace where stocks are bought and sold. It provides a platform for investors to trade stocks of publicly listed companies. Examples of stock exchanges: in India, the Bombay Stock Exchange (BSE) and National Stock Exchange (NSE), located in Mumbai, Maharashtra. How do stock exchanges work? Stock exchanges work as centralized platforms where buyers and sellers come together to trade stocks. So, let's say you want to buy a stock. How does it actually happen? The answer: stockbrokers. The stock market works by having licensed stockbrokers trade shares on a stock exchange for buyers and sellers. Some brokers are still real human beings who work in person at an exchange, but they are a rarity. Today, most of what brokers do is completed electronically. Even though much of the brokering is done electronically nowadays, traditional trading hours apply to many stock markets. The share market trading time for both NSE and BSE in India runs from 9:15 a.m. to 3:30 p.m., Monday to Friday. Traders can buy and sell their orders without any restrictions during this period. How are stock prices determined? Pricing is a very important part of the market. Put very simply, the price of a share is decided by its supply and demand. The amount of shares available for sale and the amount of shares buyers want determines how a stock is priced by the market. If a lot of people want to buy stock in one company, high demand, the price may go up. If there are too many people wanting to sell stock, high supply, in one company, the price may go down. How a specific stock price is determined by buyers and sellers in the market most often happens through an auction process. In this process, buyers submit the price they are willing to pay, a bid, and the sellers submit the price they would like for their stock, the ask. When the two align, a trade is made. There are millions of people placing orders on the stock market every day in stock exchanges around the world. This auction process can be vast and quick-moving. This is what causes stock prices to change by the second, either rising or falling in cost. At this speed of trading, sometimes by the time your bid or ask is placed to the time it is traded, which could be fractions of a second, the price may have shifted. Also, there may not always be a buyer and a seller who instantly match each other in price. In that case, some markets use specialists to make constant bids and asks so that trades can be made continuously. Before we go deeper, let's get familiar with a few basic terms. Stocks and shares are pieces of a company. Investors are people who buy these pieces, and return is the money you make from investing. Why people invest in the stock market? People invest in the stock market because it offers the potential for their money to grow over time. While prices go up and down, the stock market has historically shown growth over the long term. A final word. The hardest part of making progress on anything is getting started. So, congratulations on taking the first step and learning about the stock market. Now that you know the basics, it will be easier to decide what your investment goals are and pick which method works for you. We are always here with information and resources to help you out. In our next episode, we'll dive into investing risk and return, the balance of reward and caution in investing. Stay tuned and remember, anybody can invest. Happy investing!